Welcome back to Investing Talk Podcast. Today, we're taking a close look at Maxeon Solar Technologies. One of our listeners sent in a stack of reports, actually, and we've distilled the crucial information to give you a clear understanding of what's happening with this solar innovator.
That's right. We have before us a 2025 due diligence report, a strategic business update from May 2025, and also a stock analysis from May. So our goal today is really to synthesize these sources and understand, well, Maxeon's current financial health, their significant strategic shift, and what the analysts are indicating.
Okay, let's get into it. Maxeon specializes in advanced solar panels. They're known for high efficiency, reliability, sustainability. I mean, they even boast warranties up to 40 years.
Which is pretty impressive.
Right. They used to be part of SunPower, spun off back in 2020. But now, well, things are changing significantly for them. Let's start maybe by examining their financial status as of fiscal year 2024. Revenue was $509 million.
Yeah, and that's a considerable decrease from the $1.12 billion recorded in 2023.
It really is. This big year-over-year fluctuation, it just underscores the volatile nature of the solar market, doesn't it?
It does. And what's particularly notable here, this revenue volatility isn't just between 23 and 24. Looking at the due diligence report, it shows $658.41 million in revenue for 2022. So it's been up and down.
Okay.
This inconsistency, it likely points to, intense competitive pressures within the solar industry and maybe shifts in their sales strategies or even key market segments.
Right.
It kind of prompts us to consider if their historical strengths, like those high-efficiency panels, are really enough in the current landscape.
And it seems those market dynamics, the competitive forces, are definitely impacting their profitability. Yeah. Their earnings per share, TTM, last 12 months, it's a substantial negative, 549.589 cents.
Wow.
So as you can imagine, a price-to-earnings ratio isn't really a useful metric for valuation right now.
No, precisely. With negative earnings, the PE ratio just, it becomes uninterpretable, doesn't tell you much. These significant losses, they suggest pretty considerable challenges in achieving profitability in their current operations.
And their return on equity is also negative. As I understand it, this means they aren't generating positive returns on the capital invested by their shareholders, especially when you compare them to others in the solar sector.
Yeah, if we look at the broader implications, a negative ROE, it often signals that a company isn't effectively deploying shareholder funds to generate profit. The due diligence report highlights that a positive ROE is generally what investors are looking for. It indicates efficient use of capital.
Makes sense.
So Maxeon's negative ROE is definitely a key area of concern for potential investors. Think of return on equity as a measure of how effectively a company is using your money as a shareholder to generate profit. A negative ROE suggests that instead of growing your investment, the company is, currently shrinking it.
Now, while we don't have the specific free cash flow figures right here, the due diligence report does note that negative EBIT, that's earnings before interest and taxes, often precedes potential difficulties in generating positive free cash flow.
And this raises a critical question, doesn't it, about their operational efficiency and their capacity to fund ongoing expenses and investments. While it's not explicitly stated, negative EBIT frequently correlates with a struggle to have cash readily available after covering those basic operating costs. EBIT gives us a look at how profitable the company is from its core operations, before considering the cost of its debt or taxes. So negative EBIT can be a bit of a red flag, indicating the basic business model might not be generating enough profit.
Okay, all right. But here's where the narrative takes a really significant turn. Maxeon has made this major strategic decision to focus its efforts entirely on the U.S. solar market.
This strategic pivot is indeed noteworthy. The business update details their divestiture of non-U.S. distributed generation assets, and that resulted in an inflow of approximately $94 million.
$94 million.
Yeah. So that cash injection is certainly a significant development for strengthening their financial footing.
What exactly are those distributed generation assets they sold off?
Good question. These are typically smaller scale power generation technologies located close to where the electricity is used. Think like residential solar installations, smaller commercial ones. Divesting these suggests a pretty complete pivot away from those smaller decentralized projects outside the U.S.
Got it. So that $94 million provides a much-needed boost to their balance sheet, as you said. And the rationale behind this U.S.-centric approach, it seems to be leveraging the growth opportunities within this market and, hopefully simplifying their operations, concentrating on a single core region, maybe fewer regulatory complexities in the long run.
Well, concentrating on the U.S. market certainly aligns with the significant incentives and policy support for renewable energy here. By focusing their resources, they probably aim to improve their profit margins and capitalize on a market with, substantial growth potential. Those financial headwinds we just discussed likely played a big role in this decision, this bold move to focus solely on the U.S.
And it's not just about where they sell. They're also planning to establish onshore manufacturing facilities within the U.S. That feels like a substantial commitment.
Oh, it is. It's a significant undertaking, but it has multiple potential benefits. Establishing local manufacturing enhances supply chain resilience, right?
Yeah.
It reduces their vulnerability to international disruptions. And it also holds the potential to provide a competitive edge, particularly given the ongoing discussions and implementation of import restrictions.
Speaking of those import restrictions, it seems they are already presenting challenges. The recent financial results for Q4 and the full fiscal year 2024, released late April 2025, highlighted ongoing difficulties stemming from U.S. customs and border protection restrictions affecting certain imported goods. So the long-term promise is there, but immediate headwinds.
This really underscores the delicate situation they're in. While the strategic direction toward the U.S. seems well-founded, the immediate impact of these import restrictions is creating tangible difficulties, product availability and consequently revenue. It's a stark reminder of the complexities, the uncertainties involved in global supply chains and international trade, even for innovative companies like Maxeon.
And this uncertainty is clearly reflected in their stock price. It's shown considerable volatility, fluctuating between, investor concerns about these current challenges and optimism about the potential of their U.S.-focused strategy. Trading volumes have also increased around these announcements as investors reassess.
Well, the stock's volatility is a pretty logical response to this mix of near-term difficulties and long-term potential. Investors are essentially trying to gauge how effectively Maxeon will navigate these immediate obstacles and, capitalize on the opportunities in the U.S. market.
Now, it's interesting to observe the sentiment among analysts. Currently, the overall outlook appears to be, neutral. Out of 11 analysts surveyed, there are no buy or sell recommendations, but there are 2 hold ratings, which suggest a cautious sort of wait-and-see approach from the professional investment community.
That neutral sentiment likely reflects the prevailing uncertainty surrounding Maxeon's whole strategic transformation. Analysts are probably waiting for more concrete evidence that their U.S.-focused strategy is gaining traction and that they're successfully managing these import-related challenges.
However, and here's a notable point, the median price target is around $20.
$20.
Yeah. That's a significant jump from the current trading price of approximately $3.55. This substantial difference suggests that while there's near-term caution, there's also considerable optimism about their potential for future growth.
That is a really significant disparity between the current price and that median target. It suggests that analysts, while neutral for now, foresee considerable potential upside if Maxeon can successfully implement its U.S.-centric strategy and overcome these present difficulties.
That's a big if.
It's a big if. It implies a belief that the market might be undervaluing their long-term prospects, likely contingent on successfully executing their U.S. manufacturing plans, and maybe a belief that the current import issues are just temporary headwinds. But as you said, this optimism carries significant risk. Delays or further trade barriers could severely impact that potential upside.
Okay, shifting gears slightly to the competitive landscape. Maxeon operates in a very competitive solar industry. Key competitors include First Solar, SunPower, their former parent, and Canadian Solar. Each brings unique strengths.
Indeed. Each of these competitors has its own distinct focus. First Solar, for example, they're heavily focused on large-scale utility-grade projects using thin-film technology. Canadian Solar, they maintain a broad global footprint, offer a diverse portfolio of solar products.
So where does Maxeon fit in? It seems their competitive edge lies in those high-efficiency panels combined with that really long warranty we mentioned earlier.
That seems right. It positions them favorably within the premium residential and commercial segments, specifically within the U.S. market now. Their advantage seems rooted in the quality and durability of their products, making them attractive to U.S. customers willing to invest more for that long-term reliability and superior performance.
Okay, let's explicitly talk risks and opportunities. The U.S. CBP import restrictions, clearly a short-term risk, affects product availability, revenue.
Absolutely.
And broader economic factors like interest rate fluctuations could indirectly dampen demand for large solar projects, right?
For sure. The import restrictions are a significant immediate challenge. And yes, changes in interest rates can affect the financing of large solar installations, potentially reducing overall demand across the industry.
Conversely, though, their strategic decision to concentrate on the U.S., especially with government support for renewables, that presents a substantial opportunity. And successfully establishing local manufacturing could mitigate those tariff risks and create a more dependable supply chain.
Definitely. The U.S. market offers considerable opportunity, driven by policy and just increasing demand for clean energy. Establishing domestic manufacturing, it not only reduces exposure to tariff risks, but also enhances supply chain security. That's increasingly crucial in the current global environment.
And finally, let's touch upon the sentiment online. Social media discussions, it seems, largely mirror the analyst perspective.
Yeah.
Kind of a blend of cautious optimism about the U.S. focus and domestic production plans, but coupled with apprehension about the immediate consequences of trade restrictions. And, of course, always important to treat unverified online info with caution until there's official confirmation.
Exactly. The online chatter reflects this duality enthusiasm for the long-term vision in the U.S., alongside concerns about the current import challenges. It's always prudent to exercise discretion with unverified stuff and rely on official company announcements and filings.
So, to sort of summarize where we are, Maxeon is undergoing a significant transformation. They're placing a substantial bet on the U.S. solar market. They've taken steps, like the asset sales, to bolster their immediate financial position. And they're aiming for long-term growth via domestic manufacturing and focusing on their premium products.
In essence, yeah, they're strategically realigning the business to prioritize the U.S. market. They're utilizing that recent capital infusion from the asset sales to support growth initiatives, especially in domestic manufacturing. And their premium product line does position them well within specific segments of the U.S. solar landscape.
Going forward, it'll be crucial to monitor their upcoming earnings reports for, well, tangible evidence of progress in this turnaround.
Absolutely.
And of course, any regulatory changes affecting solar incentives or any further supply chain disruptions will be important factors to watch.
Key indicators of their success will definitely include their ability to navigate the current import restrictions, the progress in actually establishing those U.S. manufacturing capabilities, and naturally, their financial performance in the coming quarters. Regulatory developments in solar will also significantly influence their trajectory.
Well, this examination of Maxeon Solar Technologies gives us a really fascinating look at a company navigating what is a challenging, yet potentially very rewarding strategic shift. They are facing immediate obstacles, no doubt, but they seem to have a clear vision for their future within a critical market.
So what resonates most with you from this analysis? Do you find yourself focusing more on the near-term risks or perhaps the potential long-term benefits of this U.S.-centric strategy? This whole situation prompts an important consideration, I think, about the trade-offs between immediate challenges and future potential, especially in the renewable energy sector.
That's a great point. And if you, listening, found this kind of in-depth analysis valuable as you navigate the world of investing, please do subscribe, like, and maybe leave a comment. Let us know any other companies or topics you'd like us to explore. Your feedback really helps us tailor future discussions to your interests.
And finally, maybe consider this. Maxeon's decision highlights a broader trend, potentially. Companies reassessing their global strategies in response to geopolitical and economic shifts. What other industries might witness similar significant regional focus in the years to come? It's just something to ponder as you continue your own research.